when we spoke to him, he was cautiously bullish. He said that valuations are not great, but yeah, selectively you should start buying. Market has come up. They've surprised everybody on the upside. What's your market view now?
So, I would say that enjoy the bounce. The bounce has been caused by factors other than India. Of course, we were an oversold market, but I guess the catalyst for that was really in the United States, where as the dollar has weakened and as interest rates in America, the 10-year treasury yield has declined, that has triggered off an FI buying into the market. And I think that's the technical bounce that you're seeing. Enjoy the bounce.
Okay. What are your what has been the big portfolio positioning, let's say between December and now? QS, QT, quarter se quarter tak, dunya has world changed, right? What have you changed in your portfolio?
So basically, Nikunj, the way we have done this is that we have used this opportunity on the decline to actually add to stocks. I think to some extent we do believe that the large cap bottom may be done. We're not as sure about the mid cap and small cap bottom, whether they are done. But in that, the decline, what we have done is we have gone into sectors or companies where we believe there is greater visibility or predictability of growth and where the valuations have come down to a reasonable level. That would include utilities, private banks, NBFCs. We already had telecom. We did buy some digital commerce, insurance companies, payment companies, so on and so forth. So we have used this opportunity to buy companies where we think the valuations are more comfortable, the predictability is high, and the visibility is high. That's really what we have done.
Right. Rajesh, hi, morning. Interesting how you say enjoy the bounce. Do you think it's going to be short-lived?
So like I pointed out, I think it's possible that, we have a large cap bottom in place, but I'm not as sure about the mid cap and the small cap. Look, I think we are in a slower growing economy, right? Our growth rate has certainly slowed down. And there is a fear, at least, and there is some, thesis that the US is also engineering a slowdown. The US is 25% of world GDP. If that were to slow down as well, then it would put some more pressure on our growth rates. So why is GDP growth rate important then? It's important to earnings. Because, given where margins are of the corporate sector in India, you require now top-line growth. The substitute for that is GDP growth. So only if you have GDP growth acceleration will you have top-line growth of companies, and therefore you have earnings growth. So my sense is that there is still a fear that the slowdown of US and India combined is not out of the woods. And that's why I would say that it's not as clear, to me at least, that the bottom, at least as far as mid cap and small caps are concerned, is done.
Right. Interesting. Rajesh, wanted to get your thoughts on financials, because that really seems to be a bit of a consensus trade, if you will, on this trade. Yeah. The sector has not gone anywhere, especially the large cap banks in the last 2 odd years or so. So there is that little bit of valuation comfort as well. But how would you bifurcate within financials? Because it's a large pool.
Correct. So we do like private banks, we do like some NBFCs, and we do like life insurance companies. Those are the spots for us to like. We are not really as excited about, let us say, general insurance companies at this moment at least, or capital marketplace, even in the financial space. Or to some extent, I would say even PSU banks as a class. There may be select PSU banks that we probably like. Now, the reason for, and you're right, private banks are really becoming a bit of a consensus trade. But my sense is that, I think the feedback that we're getting from the banks is that deposit rates are quite encouraging. And I think there was a challenge of tightness in liquidity, etc., which probably the RBI is trying to address. If interest rates do come down, which they probably will, of course, that puts some pressure on the asset side, but it does improve credit growth rate, and it does improve the ability of to navigate NPAs. So my sense is, given where valuations are, this is really a spot where you don't see too many challenges as far as either growth is concerned or where either large NPAs are concerned. So my sense is the predictability of that sector is reasonably good as you move forward.
Hi Rajesh, Cheryl also joining in the conversation, and you did speak about a couple of sectors that you actually looked at, and what struck to me was, I believe you said platform companies. What was the rationale behind that?
So look, the digital companies, and I'm not really including some of the food delivery companies at this moment or quick commerce companies, but look, these are platform companies which are really betting on 100 crore customers which are on the mobile telephone, right? And they are basically leveraging on that. And the penetration of their business, respective businesses, is still quite low. And my sense is that the opportunity to kind of grow non-linearly is reasonably high. So that's really that's where the attraction is. Also, I think these are no longer at narrative stage. These are proven business models now. So we would avoid companies had they been very early or at narrative stage. They've moved from a narrative stage to a growth proven business model and a growth rate, and that's why the attraction to buy these digital commerce companies.
Rajesh, they say that you should buy something ahead of the curve. That's how you make money.
Absolutely.
If it is a cherry consensus, then it's in the price.
Correct.
And I get that feeling for banks. I'm yet to find somebody who says I don't like banks. I'm yet to find somebody who says that I'm not bullish on banks. I'm yet to find somebody who says that I'm underweight banks.
Yeah.
If everybody is saying the same thing, aren't banking stocks then pricing in what is called as cherry consensus?
No, Nikunj, you're absolutely right. Banks has been a consensus for probably 3 years or 4 years because the valuations have been a lot more comfortable, but not that necessarily that all banks have delivered quite well. But I would say that there are some banks which are facing, let us say, challenges in terms of acquisition, etc. They have taken time to digest that acquisition. Now, if you actually form a thesis, I would say that the valuations have come down dramatically from where they were. They were considered the stars as far as valuations are concerned, then they've moderated to a fairly low level of valuation. Given their ROE, that valuation seems to be justified. And they seem to be at the bottom of the economic performance as well. So you're closer to the bottom of valuations, closer to the bottom of economic performance. So as you move forward, as they digest that acquisition, my sense is that both will correct as you move forward. And that's why my sense is that the thesis holds. But you're right that the thesis for private banks has been there for quite some time. But I would say that in the recent past, as time has elapsed, that thesis has improved.
So if one is looking at, let's say, understanding the market from here, what are the factors at play? Valuations are just about okay, earnings are not great. I mean, they're okay. So then what should one expect from here till next 12 to 18 months? Very scattered returns, no returns, or low returns?
So I would really say control your enthusiasm. But my sense is that there is still opportunity in stock picking. So there is, I think you'll have to find pockets, right? So for instance, there's no point in, doing any bottom up on consumption staples or something like that. So there are areas and pockets of visibility and predictability. That's where you ought to be going. So my sense is it's going to be a lot more stock specific market. It's not going to be a trending market. On an overall market basis, I would say keep your enthusiasm low.
Okay.
Right, Rajesh, I wanted to understand your view coming in for the power space, because the rest of the market, while we were all watching closely what banks are doing, even power sector also saw a very rapid rise in this sort of comeback rally. So what's your take on the power space? Are you betting on this one? Are you liking it?
No, absolutely. We do. I think the visibility on the power capital expenditure is reasonably high. Now, the entire part of the value chain of power is not necessarily very strong. There is a challenge of distribution. SABs are still very weak players. There is a challenge of transmission capacity and so on and so forth. But having said that, I think given where we are and given the growth rate of the economy, my sense is that you're going to require a lot of power capacity, probably at 7 or 8% volume growth, if not more, as you move forward. The climate is getting warmer. The AC demand, you can see it's rising very fast. People are moving to electric vehicles. We are encouraging manufacturing. Our GDP by itself is growing. Rural houses are getting power. So my sense is that the power demand is going to continue to remain at elevated levels. So you will require a lot of power capacity to come in. That, again, the visibility and predictability of that is very high. Not necessarily the entire value chain is very strong, But my sense is over a period of time, it'll definitely happen. So we prefer the utilities where we think that the valuations have come down to reasonably attractive levels.
Rajesh, what do you have to say about autos? Because, of course, for select auto anchors and even auto players, there is that entire US tariff risk. Other than that, channel checks are also, indicating weak demand. I mean, in the recent months, your PV and two-wheeler sales registrations are actually down 11 and 6% respectively.
No, absolutely. And I think that's a part of the consumption play. But even commercial vehicle demand is, fairly flat. So PVs, two-wheelers, or commercial vehicles, all the three categories are actually showing very, very tepid demand. And there's a challenge of inflation as well, in terms of, the metal prices have all gone up. So my sense is that they will have to absorb those prices. Some of the auto companies have raised prices, as you would see in the last 1 week or so. So there's a question of margins as well. So my sense is that there's an absence of volume growth, or definitely an absence of visibility, whether that can grow at a very attractive rate. Valuations are not necessarily at very, very cheap levels. So my sense is that's a sector to avoid for the moment. The companies are great. I mean, the profitability, the ROEs of companies in the auto space is great. But my sense is that that's not really a space where you can make big alpha at this moment.
I'm just looking at the market right now, and what do we have? We have a market which is steady. We have a market which is very, very steady. You mentioned platform, and when we say platform, we think Zomato. When we say platform, we think Paytm. But Nykaa is also platform. India Mart is also platform. How would you define platform? I mean, MCX is also platform. BSE is also platform.
Yeah, absolutely.
CDSL is also platform, right? Or कुछ miss कर रहा हूँ मैं?
No, I think, I would say that, there is an oligopoly even in the, the CAMs and so on and so forth space. So I think those are also the type of companies that you would include. PB FinTech is another name. I mean, we may own some of these companies, but just to answer your question, that these are also included as far as platforms are concerned.
For me, Rajesh, this year is going to be interest rates, right? I mean, interest rates will come down. Whether it is 25, whether it is 50, whether it is 75, whether it is 100, I don't know. Nobody knows. Even RBI doesn't know right now.
Sure.
But interest rates will come down. When interest rates will come down, utilities will do well. When interest rates will come down, high debt companies will do well. When interest rates will come down, banks will do well. What is the best play on a declining interest rate environment?
You would include NBFCs as well. The cost of borrowing for NBFCs will also come down. But my sense is that if interest rates are coming down, I think that should be good for credit growth. Now, look, I think we already have a challenge with government having to control its fiscal deficit. So the G part of the GDP, right, in terms of C plus G plus I plus X minus M, the government expenditure was the one which was really driving GDP. And that has kind of taken a backseat because you have to control debt to GDP. So the fiscal deficit is in the consolidation mode. I think monetary policy is what you have to kind of encourage growth. And that's why I would say banks are a good way to play that credit growth. So my sense is that the broader effect of that on the economy, that it encourages a more credit growth and it encourages GDP growth, that I think is more material. But to answer your question, I would say your NBFC is also a good play on their costs going down because interest rates are going down.
Rajesh, the other space I wanted to talk about was, I mean, I know even though you're not a fan of the mid and small cap universe, but defense. Given that the DAC, the Defense Acquisition Council, has now approved guidelines for faster capital acquisition process, does that give you any sort of, feeler that maybe defense stocks selectively are already on their recovery and have come off quite a fair bit from those recent lows? But do you think that selectively one can again get a little bit bullish and add on to positions when it comes to defense names? Because the order inflows as well are coming in.
So I have been more in the defense space where I can see a clear moat. I mean, and those tend to be a little more larger companies. And yes, you're right. I have a challenge with predictability in terms of growth rate. I can't really forecast what the next 2 years or 3 years will look like, what the order books will be, etc. But my sense is that as you move forward, the valuations have definitely corrected. The moats are intact. So you'll have to just take a longer term view as far as defense is concerned, because all of the factors that were tailwinds for defense hold. in terms of indigenization, capital expenditure being a priority, exports can be a possibility, so on and so forth. So all those tailwinds for those do exist. I have a challenge with predictability, but my sense is that if you hold those stocks for the medium term, you will have to navigate the volatility that will persist with that. But my sense is that these are good bets to have over the medium term.
Really appreciate your time. Thank you for joining us. So nice to have you back. Now, markets, meanwhile.
If you like this video, then like, share and subscribe to ET Now.